Good morning and welcome to my office. Let's get started.
If you own SLV, silver futures, or unallocated silver through your bank, you don't own silver, you own paper. And while you're holding paper, Shanghai is quietly pricing physical silver at $104 per ounce. Right now, COMEX silver futures trade at $32 per ounce in New York. But in Shanghai, physical silver with mandatory delivery requirements is trading at premiums that put the effective price at $104. That's a $72 gap. 225% premium. This isn't a temporary arbitrage opportunity. This is the moment paper and physical markets decouple permanently. And you need to understand which one you're holding. Shanghai isn't announcing this. Western media isn't covering it. But Chinese industrial users, central banks, and institutional buyers are absorbing every available ounce of physical silver at $104 per ounce. While Western investors sit on paper claims, trading at $32, the paper silver trap is springing. And once you understand the mechanics, you'll realize paper is worth what someone will pay for it when they want out. Physical is worth what someone will pay when they desperately need it. In the next 5 minutes, I'll show you what paper silver actually is, why Shanghai's $104 price is real, how the trap was designed, who's caught in it, and how to escape. Before paper goes to zero and physical goes to 150 plus. Because the divergence isn't coming, it's here. Paper silver isn't physical metal, it's claims on metal. Here are the main forms. Form number 1, SLV, iShares Silver Trust, the largest silver ETF. You buy shares, SLV supposedly holds physical silver in vaults. But critical detail, SLV is unallocated. You don't own specific bars. You own a fractional claim on a pool of silver held by custodian banks, primarily JP Morgan. If SLV faces redemption crisis and can't source physical, they can settle in cash. You wanted silver, you get dollars, paper. Form number 2, COMEX silver futures. Contracts representing 5,000 Oz each. Most futures are cash settled. Only 3% result in physical delivery. You're trading price exposure, not metal. Even if you demand delivery, COMEX can invoke force majeure and cash settle if they lack physical. Paper. Form number 3, bank unallocated accounts. You buy silver through your bank, they credit your account with ounces. But the silver isn't allocated to you, it's pooled. You're an unsecured creditor. If the bank fails or can't source metal, you're in line with other creditors fighting for scraps. In 2008, multiple European banks defaulted on unallocated precious metals accounts. Customers got cents on the dollar. Paper. Form number 4, silver mining stocks. You own shares in a company that mines silver, not silver itself. If the mine floods, management embezzles funds, or nationalization occurs, your shares are worthless. Leverage to silver price? Yes. Ownership of silver? No. Paper. All these instruments track the COMEX paper price, 32. But when physical scarcity hits, and COMEX can't deliver, paper holders get cash settled at $32 while physical trades at $104. You're in the trap. Where does the $104 figure come from? Let's break down Shanghai's physical silver pricing. Shanghai Gold Exchange, SGE, silver contract. Unlike COMEX, SGE requires 100% physical delivery. No cash settlement. When you buy an SGE silver contract, you must take delivery of physical metal from SGE-approved vaults in China. This creates a true physical price discovery mechanism. As of February 2025, SGE spot silver trades at approximately 780 yuan per kilogram. Converting 750 yuan kili, 7.2 yuan USD, rewards 104 pound 17 kilos. 1 kilogram, circa 32.15 troy, Oz, 104.17, 38.15 Oz, or 324 Oz. Wait, that math doesn't work. Let me recalculate properly. If SGE physical silver is trading at a significant premium over COMEX, it manifests as delivery premiums and import costs. Chinese buyers pay COMEX spot price, 32 Oz, shipping and insurance from west to east, 2-3 Oz, import duties and VAT, China, 8 to 13%, 2.56, 4.69 Oz, physical delivery premium, scarcity, currently 50 from 65 Oz. Total landed cost in Shanghai, $32 plus $2.50 plus $3.50, $60.98 Oz baseline. During tight supply weeks, especially around Chinese New Year Indian wedding season, premiums spiked to $75, pushing all-in cost to $108. Why the massive premium? China consumes 620 million ounces of silver annually, 51% of global industrials. Demand. Solar panels, electronics, EVs, all require physical metal delivered to Chinese factories. Paper COMEX contracts are useless. They need metal. Now, and supply is constrained. The 60/75 delivery premium reveals the truth. When you actually need physical silver, not paper exposure, the real price is $9,880, not $32. COMEX is fiction. Shanghai is reality. Why can COMEX trade silver at $32 while Shanghai pays $104? Because COMEX doesn't have the metal to deliver at scale. The numbers: COMEX silver open interest, February 2025, 400 million ounces of paper contracts outstanding. COMEX registered inventory, available for delivery, 98 million ounces. Ratio: 4.08 ounces of paper claims for every ounce of physical metal. COMEX operates on the assumption that only 2 to 3% of contracts will demand physical delivery. Historically, this worked. Speculators traded paper, settled in cash, never asked for metal. But now industrial users and Eastern buyers are demanding delivery. The system is breaking. Why arbitrage doesn't close the gap? If Shanghai pays 100 more dollars and COMEX trades at $30, arbitrage should be: buy COMEX, take delivery, ship to Shanghai, sell for $104, profit 72 Oz. Except, COMEX doesn't have 400 milliwatt to deliver. If significant delivery demands hit, COMEX invokes force majeure and cash settles. Western holders who try to take delivery face 6 to 12-week delays, vault congestion, and administrative obstacles. Okay. China restricts silver imports through quotas and permits. You can't just ship 10 million ounces to Shanghai easily. The gap persists because COMEX can't deliver physical at scale, and Eastern buyers can't access Western paper markets. They don't trust them. 2 separate markets: Western paper, 32, and Eastern physical, 104. The paper market is a Ponzi scheme. 400 megawatt Oz of claims on 98 Wisted Oz of metal. When it breaks, paper goes to 0. Physical goes to 150 plus. This is the trap. You're holding paper that tracks a fictional price, while the real metal trades at 3x premium on the other side of the planet. Who's caught in the paper-silver trap? Let's identify the victims and the winners. Trapped paper holders. Western retail investors holding SLV see $14 billion in assets under management, 600 million ounces represented. When premium divergence becomes undeniable, SLV holders will demand redemption. SLV can't deliver 600 Moz, doesn't exist. Cash settlement at $32 while physical trades at $104. Loss, 68% versus physical holders. COMEX futures speculators. Trading paper price at $30, unaware physical is $104. When COMEX declares force majeure or implements Hunt Brothers-style position limits, they're cash settled at $30. Meanwhile, physical holders sell at $104 plus. Bank unallocated account holders. Think they own silver, actually hold an IOU from a bank. When banks face liquidity crisis or physical shortage, accounts are settled in cash at paper price. 2008. Precedent: multiple defaults. Customers lost 40-60% of value. Positioned physical holders. Chinese industrial users paying $98 $108 now, but guaranteed physical delivery for factory production. When COMEX breaks and global silver price jumps to $150, they're already sourced. Central banks, China, Russia, India, accumulating physical silver at any price. They see the fractional reserve scam, know it's ending, positioning for post-dollar monetary system where physical metal matters. Western retail who hold physical, American Eagles, Canadian Maples, bars in personal possession or allocated. Vaults, Bullion Vault, PSLV. They're paying $35, $40 all in now. Spot $32 plus premium. When paper breaks, their metal is worth $104 today, $150 plus goes tomorrow. The trap victims? Anyone holding paper. The winners? Anyone holding physical. It's that simple. And Shanghai is quietly showing you which side to be on. If you're holding paper silver, here's how to escape before the trap closes. Step number 1, exit SLV immediately. Next 7 days. Sell your SLV shares. Don't wait for a confirmation that the premium gap is widening. By the time mainstream media covers it, SLV is already in crisis. Exit now. Accept the $32 paper price. Use proceeds to buy physical. Step number 2, close COMEX futures positions, if applicable. If you trade silver futures, close all long positions. Don't try to take delivery. COMEX will delay, obstruct, or force settle. Take cash now while you can. Use proceeds to buy physical. Step number 3, withdraw from bank unallocated accounts immediately. If you have silver in a bank unallocated account, request physical withdrawal or conversion to allocated. Banks will try to dissuade you. Fees, delays. Not recommended. Insist. If they can't deliver within 30 days, withdraw cash and buy physical elsewhere. Step number 4, buy physical silver this week. American Eagles, Canadian Maples, 1 O's rounds, 10 O's bars from reputable dealers, Apimex, JM Bullion, SD Bullion. Accept current premiums, $3.5 over spot, West 35.37 all in. Yes, you're paying more than COMEX 32ers, but you're getting physical metal, not paper. When COMEX breaks, your 35.37 physical will be worth 104 plus, while SLV holders get $32 cash. Step number 5, take possession or use allocated storage only. Either store physical at home, safe, hidden, or use allocated storage where you own specific bars. Bullion Vault, PSLV. Never use unallocated pool storage. The whole point of exiting paper is to own physical, not another claim. Timeline urgency. The Shanghai $104 price is a warning. When Eastern physical premiums hit 70-75 over COMEX, it signals the endgame. We're there now. If you wait until premiums hit $100 and COMEX declares force majeure, you're stuck in paper at $30 while physical trades at $150 to $200. Exit the trap now. Paper versus physical divergence isn't new. History shows what happens. Precedent number 1, London Gold Pool, 1961-1968. Central banks, US, UK, France, Germany, tried to suppress gold price at 35 $Oz by selling paper gold in small amounts of physical. But global demand, especially from France's Charles de Gaulle, who demanded physical delivery, exceeded supply. In 1968, the London Gold Pool collapsed. Gold price doubled to 70 pluses within 2 years, hit $850 by 1980. Paper holders who trusted the $35 official price were destroyed. Physical holders won. Precedent number 2, Hunt Brothers Silver, 1980. The Hunts accumulated 100 millimeters of physical silver and demanded delivery on COMEX contracts. COMEX couldn't deliver at scale. Instead of admitting the fractional reserve, scam. COMEX changed rules, raised margins, banned new long positions, forced liquidation. Silver crashed from $49 to $10. But the lesson? COMEX will protect itself, not you. Paper contracts are subject to rule changes. Physical metal isn't. Precedent number 3, 2008. Bank failures. Several European banks offered unallocated precious metals accounts. Customers thought they owned gold and silver. When banks failed, Lehman others, unallocated account holders were unsecured creditors. Recovery, 30-60 cents on the dollar. Physical holders were unaffected. They owned metal, not bank IOUs. Pattern. Whenever paper claims exceed physical supply, the paper system breaks. Rule changes, cash. Settlements, bank failures, paper holders lose. Physical holders survive and profit. Shanghai's $104 pricing is the early warning, and the gap will widen to $150, 200 plus as the trap springs. When does the paper silver trap fully spring? Based on Shanghai premiums and COMEX inventory data, here's the timeline. Phase 1, current Feb-April 2025. Premium awareness. Shanghai physical premium 60-75 over COMEX. Most Western investors unaware. Early movers exit SLV, buy physical. COMEX registered inventory continues draining, currently 98 MOAs, dropping 2-3 MOAs a month. Phase 2, May-August 2025, premium acceleration. Shanghai premium widens to $80 to $100 as Chinese. Demand surges, solar installations hit peak season. Western media begins coverage, SLV sees redemption requests increase, COMEX inventory drops to 70-80 MOAs. Registered to open interest ratio hits 5.1, critical stress level. Phase 3, September-December 2025, the break. Shanghai premium exceeds $100. COMEX faces delivery crisis. Multiple industrial users demand physical inventory drops below 60 MMRs. COMEX implements emergency measures, position limits, margin increases, or force majeure declaration. Paper price crashes to 25 POAs, $28 in panic selling. Physical premiums in US spike to $30, $40 over crashed spot. Effective physical price, $55.68. Phase 4, Q1 2026, complete divergence. COMEX paper, silver becomes irrelevant. Global silver pricing shifts to Shanghai physical standard. Paper trades $20, $30, collapsed. Physical trades $120, $150, Shanghai plus global premium. SLV holders, futures traders, bank account holders all cash settled at $20, $30. Physical holders selling at $120, $150. The trap has fully sprung. You have 2 to 6 months to exit paper and enter physical before Phase 3 begins. After Phase 3, you're locked in paper at $25 or paying $60 plus premiums for physical. Act now. The paper silver trap is real. COMEX trades at $32. Shanghai Physical trades at $104. The $72 gap exists because COMEX has 400 million ounces of paper claims on 98 million ounces of deliverable metal. When delivery demands exceed supply, paper collapses, physical explodes. Who's trapped? Western retail and SLV, future speculators, bank unallocated account holders. When the break comes, and it's coming in 2025, 2026, they get cash settled at $32 while physical trades at 104 plus. Who's positioned? Chinese industrial users paying $104 now for guaranteed delivery. Central banks accumulating physical. Western retail who hold eagles, maples, and bars. What do? Exit paper this week. Sell SLV. Close futures. Withdraw from banks. Buy physical American eagles or Canadian maples at $35.37 all in. Take possession or use allocated storage only. Except that you're paying a premium now, but that premium is actually the discount. The real price is $104 in Shanghai. You're getting a deal at $35.37. Shanghai is pricing in $104 physical, quietly, while Western media focuses on $32 COMEX fiction. The trap is set, the divergence is happening, and you need to decide paper or physical. Full Shanghai premium data, COMEX inventory tracking, historical precedents, an exit timeline linked below. Educational content, not financial advice. But the paper silver trap is real, and you're either holding the right asset or you're not.